What if I told you the secret to investing in 2025 was written in 1982? In that year, Warren Buffett quietly dropped 5 timeless investing lessons that still outperform hype, headlines, and hot tips, even today. In this video, I'll unpack those lessons with real-world examples like GEICO, Apple, Amazon, Zomato, and more, and show you exactly how to use them in your portfolio. Stick around till the end, because Lesson 5 is something even smart investors overlook, and it could protect you from one of the biggest traps in the market today. And if you're here to grow smarter with your money, subscribe now. This channel helps you invest with clarity, confidence, and conviction. Lesson 1. Accounting earnings can seriously misrepresent economic reality. In 1982, Buffett's company, Berkshire Hathaway, owned 35% of GEICO. The business was doing great. But according to accounting rules, Buffett could only report the dividends received, not the massive earnings GEICO kept and reinvested. So, while the true value of Berkshire's stake in GEICO was growing rapidly, the official earnings report barely showed it. Look at Alphabet Google today. It owns stakes in startups, invests in AI research, and keeps billions of profits inside the company. If you only look at net income, you're missing the full picture of long-term value creation. On the flip side, companies like Yes Bank might look cheap based on accounting earnings, but if the underlying economic engine is broken, reported earnings mean nothing. Don't blindly trust the P&L. Look deeper. Check what the company is retaining and reinvesting. Read the cash flow statement. Follow how retained earnings impact book value and intrinsic value. This is how you spot hidden gems before the market wakes up. Now that you know why reported earnings can mislead you, let's go deeper. What actually matters is what companies do with the profits they keep. And that's where the next big lesson comes in. Lesson 2. Retained earnings must grow your wealth. Each dollar of retained earnings should translate into at least $1 of market value. Retained earnings are what's left after a company pays expenses and dividends. But what matters is what they do with that money. Example 1. Apple. For years, Apple retained billions. They launched the iPhone, built the App Store, created the M1 chip, and bought back stock. Every rupee kept became more than a rupee in market value. Example 2. Paytm. Paytm has retained plenty, but has it translated into market value? Not really. Multiple business pivots, unclear profitability, and questionable capital use have kept investors cautious. Buffett's rule helps you judge management performance. Are they great capital allocators or just hoarders? Look for companies with a high return on equity, ROE. Track how retained earnings impact per-share book value. Avoid companies where profits are reinvested into low-return projects or vanity expansions. If retained earnings don't become market value, it's just hoarding, not growth. Even if a company reinvests its profits perfectly, there's one thing that can ruin your returns: paying too much for the stock. And that brings us to Buffett's third warning. Lesson 3. Never overpay even for the best company. A too high purchase price can undo a decade of good results. People love great businesses, but Buffett warns, price matters more than popularity. Cisco, 1999. Investors bought Cisco at 80x earnings during the dot-com boom. Even though Cisco kept growing, the stock didn't recover for over a decade. Why? The starting valuation was too high. See 3.ai or Snowflake in 2021. Both were hot AI stocks with high potential, but the IPO hype pushed valuations sky high. When growth slowed even slightly, the stocks tanked, hurting retail investors. Conversely, look into Infosys in 2001 to 2003. During the tech crash, Infosys was still profitable, but its stock crashed. Those who bought during fear and held for 10 years saw over 10x returns. As a value investor, use the PEG ratio, price earnings to growth. Look for margin of safety. Don't buy perfection priced for the future. Buffett's advice: it's better to buy a great company at a fair price than a fair company at a great price. Patience. Popularity. So if timing and price matter so much, how can a small investor like you participate without making huge mistakes? Buffett had a surprisingly simple answer: buy small slices of great businesses. Lesson 4. You don't need to buy the whole business. Buying fractional interests in great businesses can beat full ownership. This is one of the most empowering truths for retail investors. Buffett couldn't buy all of the Washington Post, so he bought some shares, and he made 10x returns. Today, you can own a piece of TCS, Asian Paints, Nestle, or Apple with a few hundred rupees or dollars. You get the same benefits, profits, growth, and dividends as a large shareholder. Owning just 10 shares of HDFC Bank in 2010 could have turned into a 4-5x return today with zero effort. Meanwhile, running your own small business requires time, energy, risk, and overheads. Think of yourself as a business owner, not a stock trader. Focus on businesses with strong moats, consistent returns, and capable management. Build your own mini Berkshire one stock at a time. You don't need a factory, you need a demat account and discipline. But owning a great business isn't enough. What if management starts giving your ownership away bit by bit? That's the final danger Buffett warned about, and it's more common than you think. Lesson 5. Avoid value-destroying share dilution. Never issue shares unless you get equal business value in return. Buffett hated it when companies used undervalued stock to make overpriced acquisitions. It's like trading gold for silver. Zomato Blinkit deal. Zomato issued stock to acquire Blinkit. The deal was controversial. Many analysts believed they overpaid, using valuable equity for a business with unclear profitability. Result? Investor confidence dropped, share dilution occurred, stock price fell. In contrast, when HUL acquires, they use cash or minimal equity, and only when the acquisition fits their long-term strategy. Watch for companies making frequent stock-based acquisitions. Read the shareholding pattern. Is promoter stake getting diluted? Check if per-share earnings and book value are rising or falling post-acquisition. Issuing stock isn't bad, but doing it without fair value exchange destroys shareholder wealth. So far, we've uncovered some eye-opening truths. Let's recap the 5 timeless lessons from Buffett's 1982 letter. Don't trust accounting numbers blindly. Dig deeper. Retained earnings should grow your wealth, not just sit there. Even great companies can be terrible buys if the price is too high. You don't need to own the whole business. Own a piece and hold tight. Be alert when companies issue too much stock. It could be a wealth destroyer. In a world that moves fast, investing asks you to slow down, to see clearly, not just what's shiny now, but what will last. Warren Buffett once said, "The stock market is designed to transfer money from the impatient to the patient." And Zen says, "Sitting quietly doing nothing, spring comes and the grass grows by itself." Your job isn't to chase noise or time the market. It's to observe, understand, and act only when the odds are in your favor. Because wealth isn't built in the chaos, it's built in stillness. So breathe, think, then invest with purpose. If this video gave you clarity, hit that like button. Subscribe if you want to keep learning how to invest with common sense and confidence.